Welcome to the UK Mortgage Market Insights for the week ending Friday, the 24th of July, 2026. I hope you're all well. Now, this week we've got a lot to get through. Swap rates are on the move. 16 lenders increasing their rates this week. We'll look at the renewed tension in the Middle East and the new Prime Minister's first week, and whether his money-saving gestures could actually cost us more in the long run. Plus, the latest inflation figures, two different house price indices, and the newest labour market data. So make sure you stick around, because towards the end of the video, I'll tell you exactly who benefits most from where things stand right now. Before we get into that, if you find this useful, please do hit subscribe. It genuinely helps more people find the channel than you can imagine. And speaking of things not going our way this last week, if you're still recovering from England not winning the World Cup, well, I'm afraid the mortgage market isn't going to make you cheer up much either. So let's start where we always start, with swap rates, because these are what actually drive fixed rate mortgage pricing behind the scenes. The 2-year swap is sitting at 4.297 and the 5-year is at 4.361, both up on the week. Last week we had 4.179 and 4.260, so a noticeable move in a short space of time. And when swap rates rise like that, lenders don't hang about, which brings us nicely on to the next segment. Because this week has been frankly relentless. We've had Co-op, TSB and TSB again twice in 1 week. Skipton, HSBC, Halifax, BM Solutions, Barclays, West Brom, Accord twice on their higher loan-to-value products. Santander, NatWest, Rely, Leeds Building Society, Bank of Ireland, The Mortgage Works, Atom Bank and Nationwide all increasing rates this week. Let me just get my breath back, because that was an awful lot. Anyway, Halifax and TSB moved by up to 0.2%, Accord by up to 0.26%, Nationwide up to 0.23%, BM Solutions by up to 0.19%. So look, if you've got a mortgage offer sat on your desk right now, this is genuinely not the week to be dragging your feet on it. You need to get moving, and quickly, because who knows if this is going to continue into next week. Now, why is this happening across basically the whole market at once? Well, it ties straight back to those swap rate moves and to something rather bigger than any of us in this industry. Because the main driver behind those swap rate moves this week is what's happening in the Middle East again. The ceasefire between the US and Iran has broken down over the past few weeks, with strikes and counter-strikes picking up again. And that kind of renewed tension tends to spook the markets that set swap pricing, pushing them up. But it's not the only thing at play, because we've also got a new Prime Minister. Andy Burnham walked into Downing Street on Monday. John Healey's in as Chancellor, and in the space of about 72 hours, they've announced VAT coming off electricity bills from October, a £2 cap on single bus fares, VAT reductions for businesses and pubs, and money going towards ending rough sleeping. Now, on the surface, that's the kind of thing that plays well. Money back in people's pockets, and to be fair, it's landed at a decent moment, because inflation actually came in a bit cooler than expected to this week, which gave the new government a nice little tailwind to start with. UK inflation, the CPI figure, came in at 2.6% for the 12 months to June, down from 2.8% the month before. Core inflation held steady at 2.6%, and services inflation eased slightly from 3.7 to 3.6, though it's still running hotter than the headline number. But here's the bit that matters for us. Several analysts are already flagging that Burnham's giveaways, however well-intentioned, could put forward pressure on inflation further down the line, with some suggesting that we could be back above 3% by September and pushing towards 3.5% by early next year. So between the geopolitical tension and the new government spending, you've actually got two separate pressures pointing markets in the same direction this week. And if inflation starts creeping back up, well, you know what that does to swap rates. So it's an interesting one to watch. A government trying to ease the squeeze on households now, against a backdrop it doesn't control either, could end up making mortgages a bit stickier for those same households later on down the line. Now let's have a look at what's happening with actual bricks and mortar. Land Registry figures out this week show UK house price growth slowed to 2.7% annually in the 12 months to May, down from a revised 3.9% the month before. Before anyone panics, that's mostly a base effect. Prices have been measured against last April, right after the stamp duty changes pushed a load of buyers to rush through before the deadline. The average UK house price now sits at 271,000, England's up to 292, Wales 215, Scotland 196, and Northern Ireland's actually leading the pack, still up 7.4%. Nationwide's own index, based on mortgage approvals rather than completed sales, tells a slightly more up-to-date story. Annual growth there actually rose 2.2% in June, up from 1.7% in May. Market activity had softened a bit due to the Middle East tensions pushing energy prices up, but for a while there, since Iran and the US signed that now collapsed Memorandum of Understanding, oil prices had eased back, which have been helping market interest rates come down, before this week's renewed tension reversed some of that. And rounding off the data, the ONS labour market figures dropped this week too. Employment's ticked up to 75.1%, unemployment's edged down to 4.9%. Wages are still growing faster than prices, regular pay up 3.4%. So a labour market that's steady gives the Bank of England a bit more breathing room when it comes to interest rate decisions, even with everything else going on. Now, my own view on this, I don't think the bank will move rates at next week's meeting. I think they'll sit tight and watch how things develop. But over the course of the rest of the year, I wouldn't be surprised to see at least one increase land, especially if this inflation picture starts drifting the wrong way like we discussed earlier. So pulling all of this together, swap rates are up, driven by renewed conflict abroad and a new government spending decisions at home. 16 lenders have raised their pricing this week, and underneath all of that, the housing market and the jobs market are both holding remarkably steady, with a possible rate rise on the horizon later this year. Who benefits most from where things stand right now? Well, look, honestly, buyers with their finances in order and a bit of urgency. Rates are moving up, not down, so locking something in now rather than waiting is looking like the smarter play. And for anyone remortgaging, if your deal is ending in the next 6 months, this is exactly the kind of week where getting ahead of it pays off. Don't delay, don't bury your head in the sand, secure a rate right now before they go any higher. So that's your UK mortgage market insights for the week ending Friday the 24th of July 2026. Remember, if you don't already, please hit subscribe so you don't miss these updates in the future. Thanks for watching. I'll see you next week. Take care.